Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I'm speaking with Andrew McVeigh, founder of Australian private credit firm Remara, and we're covering the Australian private credit landscape, how it compares to what's happening in the US, and what's ahead for the asset class. Andrew, you spent nearly a decade as CFO of Brookfield's Asia Pacific business. What was the moment you saw the gap in the market that became Ramara?
I think when I was at Brookfield, I saw a few structural elements of the market that provided an opportunity set in and around credit investing for borrowers who were probably underserviced at that point and still have continued to be. And then on the investor side, the opportunity for a consistent income product that was built on institutional rigor from a credit perspective, and something that wasn't traditional fixed income or listed bond product. And that really drove the opportunity around the Ramara business as it is today. And those structural tailwinds or gaps in the market are still very much prevalent and are continuing, and I think they will continue into the future.
There's been significant stress coming out of the US private credit market. How does the way credit is structured here compare to what's happening over there? If you can paint a picture.
Certainly. I think fundamentally it's very different. The US private credit market is predominantly off cash flow lens, whereas the Australian market is more asset backed. That asset backing gives you tangible assets for recourse, and that is fundamentally extremely different to the US market. US market obviously has a lot of sponsor-backed loans. There are fewer of those loans, and that is a much smaller industry here in the Australian market. And obviously there's a lot more SaaS-based lending that occurs through the US market, and that's considerably lower in the Australian market. The Australian non-bank space is predominantly focused around, as I said before, asset-backed lending, and they're more to middle markets or smaller businesses, development projects, things of that nature. The tangible asset backing actually provides substantial coverage for investors, and I think that gives a very, very different security benefit to investors to what they traditionally see in the US. However, that being said, there are nuances around gating of redemptions and things like that, which are key for investments that are not as liquid as public markets, to ensure that investor protections are maintained if you do have redemptions and things like that on the fund, to make sure that investors are not forced to have losses just because you need to liquidate assets or liquidate things that are illiquid in nature.
Andrew, where would you say Ramara sits in the Australian private credit landscape? What makes you different?
Well, I think structurally we're quite different to most other participants. We have several businesses that originate the underlying loans direct to borrower level, and that gives us a lot of granularity but a lot of diversification across our pool. We go generally across 9 different types of credit asset class. So as a result of that, we don't have substantial exposure or overexposure to certain industries, certain asset types, or certain lending verticals. And that gives us probably a little bit more diversification than most others in the market. The origination platforms and the fact that we're direct to borrower gives us the ability to be able to manage and maneuver based on macro and micro economic conditions at that point in time. And I think that means that we're able to better manage and change the portfolio based on the risk factors that we're seeing. The underlying nature of the majority of our loans are principal and interest, and that also then gives us a lot of embedded liquidity within the portfolio. That allows one or two things. It allows a little bit more liquidity for redemptions, and it also means that we're able to redistribute the risk of that portfolio a little bit easier than most others that are probably bullet amortization, where you get one payment and you have no cash flows through the life of the loan.
And so where do the loans in your funds actually come from?
So we've got several relationships through our platform where we will originate those underlying loans, and then we'll invest into those underlying loans as well. So we maintain a lot of exposure into that underlying credit profile and those credit loans. And that gives us the ability to essentially have our own risk or our own capital at risk, which aligns our interest with ultimate investors.
Okay, so walk me through the fund range. What does each fund, what problems do they solve for investors?
So we've got 3 core funds, cash funds, credit funds, and our real estate fund. So for the cash fund, we're predominantly providing a solution to investors who are looking for short-term liquidity, but are looking to earn rates that are slightly higher than what you can traditionally earn through term deposits or bank. So they're obviously not term deposits, they're not insured, as you would traditionally would with an ADI, but they do offer slightly higher returns, but they do have a liquidity profile which allows 2 days at call or a fixed term investment. Our credit products are split into 3 major categories, so a low risk, a medium risk and a higher risk. Our lower risk is our investment grade fund, and that is again for someone looking for a core income of their portfolio. Return profiles are usually around the 7% plus net of fees with monthly liquidity, and they are all in investment grade credit. So it needs to go through a rating process, but they're all investment grade, so it's a much lower risk profile. Our medium risk fund is our credit income fund. That's our largest fund at the moment. And that's really focused on a mixture of investment grade and non-investment grade, slightly higher return profile. You would kind of classify that as an enhanced income. So, looking at around about the 10% plus quarterly liquidity. So liquidity isn't as readily available as the low risk investment grade fund, but the return profile suitably compensates you for the lower liquidity. And then we've got our high risk fund, which is our credit opportunities fund. That's for wholesale investors only. The other 2 funds are retail based. And the credit opportunities fund is almost an equity-like fund. So we're targeting 10% over RBA rate, so you're looking in and around the 15% range, and that's the level that we've hit now. But it's got a 12-month lockup and then quarterly redemptions after that. So again, as you go higher in that risk profile, you've got lower liquidity, but you are getting compensated for that high risk profile. And our real estate fund is really an equity alternative. So we're looking at spreading the risk in multiple development sites and looking to give people the opportunity to spread that risk, earn a equity-like return. And to date, we've achieved just over 16.5% net of fees through the life of that fund, and give people some exposure to a real estate development where you're not, one, having to undertake the work yourself, and 2, you're not going into a substantially large project that has significant risk factors. You're being spread across multiple products with a lot lower risk factors.
Childcare is a big part of what you're doing right now. Why that sector?
It's a circa 21 billion of annual funding from the government, so it's a very well supported industry from government regulation perspective. Essentially, it's around 4 billion of total funding. 90% of that actually is to banks. So from a market funding perspective, there's probably a structural undersupply of credit in that market for certain areas of that. And we don't naturally compete with the banks. We kind of work with the banks and provide assistance capital. And that's where people are looking to expand their business. They're looking to bring on a new centre, and we're able to fund the ramp up of that centre. We're able to fund the new asset within that. And the demographic profile of that subsector gives us some very strong opportunities. So 0 to 6 population growth in Australia is about 24% over the last few years and is expected to continue that way until 2041. And there's about 9,500 centres, and then there's more than 300 new childcare centres open annually. So for us at the moment, with what we've just seen with the recent tax changes around negative gearing and capital gains tax, particularly on property, exposing or gaining further exposure into industries that are heavily supported by the government, I think is favourable to our overall portfolio performance.
Okay. Where are you finding that the childcare centres are opening mostly?
Well, what's interesting about this is there is new expansion opportunities in metro locations where you've got new suburbs being created. But what you've got now is, because it is a fairly substantial industry, you've actually got a lot of replacement centres in metro areas and metro locations. And that's kind of where we're seeing some really good opportunities. It's the repositioning, or it's the purchase of an existing facility in a metro location, refurbishment works, new fit out works, and that gives the ability to essentially upskill or change the value of that underlying childcare centre. And that's what we like, because you've got an established market, you're in a metro location, you have demographic tailwinds within that area, and most Australian families probably need both parents working. So we see that as I said before, a very strong market where we think we can provide some very good risk into the portfolio. Late
last year, you said the market is getting closer to a credit event than further away. So we're halfway through the year. What's your view now?
Well, essentially, my view hasn't changed. I don't think it's something that is imminent to occur within the next 6 months. But we're certainly starting to see now the increased interest rates biting for such a prolonged period as well. There is further talk around the continuation of rate rises. We're certainly seeing demand at the consumer and the business level starting to drop off in terms of new equipment, refinancings. I think the tax changes are certainly going to have an impact on property values and property prices. And all of those factors, all of those things create uncertainty in the market. And that uncertainty means people will probably spend a little bit less. So I can't see at this point a lot of things changing that would make me have an alternate view. Our frame of reference is really to be able to adjust the portfolio in and around that view. And that's things like childcare, where it's a new asset class, it's heavily government supported, it requires a lot of structural tailwinds, or has a lot of structural tailwinds. As we start to change and manage the portfolio, we've got an eye on the future about where we think risk will be and where we think the economy will be, and we're slowly starting to move the portfolio in that direction.
Mm-hmm. All right, final question. So what does the road ahead look like for Australian private credit, and how will you know if the thesis is playing out?
Well, I certainly think the thesis is playing out, but the opportunity set now has been extremely strong. I think we've had a tremendous uptick since COVID in income generating products. I think having interest rates at zero for such a long period of time made people really sit up and take a look at alternative income streams. I think the recent tax changes has also led to a lot of people looking at alternative income streams outside of capital growth assets traditionally. So I think those structural benefits will mean there will be continued investor demand. When you overlay that with the aging population, there's definitely going to be a lot of demand for income generating products. And on the lending side, I think there is a maturing market in Australia for non-banks. I think if we do go through the thesis that the credit market slowly comes off and the Australian economy slowly comes off, the availability of credit from the traditional banking sector will probably not be as available. And I think that's a growth opportunity for other non-banks, private credit managers or alternative lenders to be able to step in and fill that void with probably a little bit more flexible capital. I think the opportunity set around that though is benefited by what ASIC is doing from a regulatory perspective. This is telltale signs of kind of a maturing market, and I think it's as we grow and as the market starts to develop, I think to ensure that investors feel comfortable with it, as well as institutions, I think the work that ASIC is doing to be able to improve the regulation is warranted, and I think it's part of just the normal market evolution.
Mm-hmm. Okay, excellent. Thanks, Andrew, for sitting down with Livewire today and sharing your insights.
No worries. Thanks, Anna.
If you enjoyed that interview, give it a like, and don't forget to look at our YouTube channel for more videos just like this.